Hi everybody, I'm Lorenzo Ippoliti from the investment team, and I'm here to quickly review what happened during this first part of the year. Of course, as you're probably aware, it was a difficult period for financial markets. There are two main things going on. One is the war, and unfortunately, after the invasion of Ukraine, a diplomatic solution has not been found yet, and there is actually no solution in sight. So the tension is still very high there. And then there is inflation, which is still very high, both in Europe and then in the US. In Europe, prices are 7.5% higher than 1 year ago, and then in the US are 8.5% higher than 1 year ago. So very high inflation that we have not been seeing for a long time. Why inflation is still so high? Actually, the bottlenecks in the global supply chains that were created after the pandemic are still in place. They've not been solved yet. So, and the new lockdowns that there are in China now are also not helping to solve these problems. And also, of course, the war is not helping because it is pushing energy prices higher. On a more general view, this confrontation between Western countries and countries like Russia, China, and India, where much of the commodities and the production facilities are located, is not helping to contain prices. So prices still very high. And faced with this high inflation, now central banks have decided that they want to intervene and do it aggressively by hiking rates. Why they do that? They do that because usually when you hike interest rate, you increase the cost of financing for companies and you slow down the economy. And if you slow down the economy, usually you slow down the inflation as well. But this time, we have to say that they have to be careful because the inflation is caused by cost. So when you increase the interest rate, you're not 100% sure that you're going to decrease inflation as well. So how financial markets have reacted to this environment? We have to say that both bonds and equities went down together, which is not the case usually, because when equities go down, usually bonds go up. But this was a correlated move down for both equities and bonds, so an even diversified portfolio suffered from this. The only asset class which was positive were commodities, but usually commodities are only a small part of portfolios, also because apart from gold, they're quite difficult to invest because you cannot buy physical commodities. You have to buy derivatives of commodities, and so they are financial instruments quite complex, which add a lot of noise to the performance of your investment. So, what to expect? We have to expect probably more volatility. Market could go down more. I mean, we are slightly underweight risk in our dynamic carteras, and we still think that especially the US could avoid a recession because company earnings are still quite good. In Europe, the situation is more difficult because Europe is more affected by the crisis in Ukraine. But anyway, we could see more volatility. We are underweight risk in our dynamic carteras. What about strategic carteras? As we always say, these carteras are built for the long term, and periods like these are taken into account when the carteras are built. So our advice is stay the course, don't look at the short-term volatility, and look at your long-term objective. Thank you very much, and speak soon.